Tax-free retirement income is usually a Roth conversation, but today it isn't. After years of working with retirees in my practice on how they can spend more by paying less to the IRS, I've seen that there's one opportunity that almost always gets overlooked and most people have no idea. Which is why in today's video, I'm going to be breaking down the details behind the tax-free retirement account hiding in plain sight. And more importantly, the hidden traps inside it that turn a tax-free opportunity into an expensive surprise for retirees who just don't see it coming. And if your portfolio is over $1 million, you're definitely going to want to stay with me until the end, because we're going to be breaking down a specific issue, actually a few different specific issues, that can turn this success into a liability. And with that, I'm John Norberg, Certified Financial Planner, and I'd like to welcome you to this latest edition of the Financial Prof series. So here we are, 2026, May, Derby season. And in 2026, the standard deduction for a single filer is 16.1K, and for a married couple, it's 32.2. On top of that, if you're 65 or older, the OBBBA, signed in July of last year, added a senior bonus deduction of $6,000 per person, which runs through 2028. If you stack those together, a single retiree over 65 can have adjusted gross income approaching $73,000 before their taxable income crosses that threshold where capital gains begin to be taxed. And for a married couple over 65, that figure is actually closer to 146K. Why is this important? Because long-term capital gains, profits on investments that are held longer than a year, are taxed federally at three possible rates: 20%, 15%, or 0%. And the rate you pay depends on your taxable income for the year. And taxable income is not your gross income. It's what remains after subtracting your standard deduction and any applicable deductions. Now, those are not small numbers. And the account that allows you to take full advantage of them, that tax-free account, if you will, that I mentioned at the top, it is a taxable brokerage account. Yes, a taxable brokerage. Known by many names, I've heard it called a single account, a joint account if you're married, or even simply just an investment account. This is the account that most people actually treat as the least interesting item on their financial balance sheet. Decades of appreciated investments just sitting there, quietly waiting to be used. And in the right hands, with the right plan and the right income management, it can actually function as a genuinely tax-advantaged vehicle in retirement, without contribution limits, without income phase-outs, without that 5-year waiting period that you probably heard about with Roth IRAs, right? There's also a feature of the taxable brokerage that almost never gets discussed alongside Roths and traditional IRAs and HSAs, and that is the stepped-up basis at death. You see, assets that are held in a taxable brokerage account until death receive a reset of their cost basis to a fair market value at that moment. Unrealized gains, accumulated over an entire investment lifetime, can pass to your heirs with no capital gains tax owed whatsoever. In a traditional IRA, the heirs pay ordinary income tax on every dollar they inherit over a compressed 10-year timeline. And for an HSA, the entire fair market value of that account is actually converted, or rather considered, taxable income to the heir in the year of death. The taxable brokerage, however, has a structural estate planning advantage that rarely gets discussed, or if it is, most people never consider it, even if they do know about it. Now, the strategy sounds elegant, and the truth is, it is. But there are traps inside of it that can quietly reverse every dollar of tax savings that you thought you were capturing. The first one involves Social Security, and it catches people completely off guard. So because most people end up claiming Social Security at some point in their lifetimes, that's where we're going to start. So the hidden cost of Social Security on capital gains income, even at the 0% rate, is not invisible to the IRS when it comes to your Social Security benefit. In fact, it counts towards what's called provisional income, and this is key to understand. Provisional income is the figure that the IRS uses to determine how much of your Social Security is subject to federal tax. And when you understand how that calculation works, the strategy actually gets considerably more complex. So let's walk through it a little bit. Provisional income is calculated by taking your adjusted gross income, AGI, which includes capital gains, adding any tax-exempt interest, and then adding 50% of your annual Social Security benefits. So For single filers, if that total falls between 25K and 34K, up to 50% of your Social Security benefit becomes taxable ordinary income. Above $34,000, that rises to 85%. Now, for married couples, the thresholds are a little bit different. It's $32,000 and $44,000. And here's a detail that makes this particularly sharp. Those thresholds have not been adjusted for inflation at all since 1984. Yes, the year of George Orwell's famous novel. What felt like a moderate income threshold 40-odd years ago now captures a significant portion of the retired middle class, which includes many people who would never have thought of themselves as high earners. And this can create what tax professionals and financial planners like myself oftentimes term the tax torpedo. When your income lands in that provisional income band, additional dollars don't simply get taxed at your ordinary bracket rate. In fact, each new dollar simultaneously pulls more of your Social Security benefit into taxable territory. And for someone in the 22% bracket, the effective marginal rate on every dollar in that range can actually climb towards 40%. A retiree, for instance, who harvests 40K in capital gains at 0% without accounting for this interaction can actually end up with a Social Security tax bill that erases a significant portion of the benefit they thought they were going to be capturing. So, the 0% strategy still works, but it requires managing your total income picture with precision, not just the capital gains line in isolation. And that's before we talk about the second trap, which actually applies specifically to retirees who haven't reached Medicare. And I work with a number of folks in this boat. So if this is you, you're going to want to listen in because it can actually create even more significant and sudden consequences if you're not aware of it. So if you're between retirement and Medicare eligibility, which comprises a lot of folks who watch these videos, right? Which really means age 65, right? Then there's a good chance you're buying health insurance on the ACA marketplace because you can't claim Medicare again before 65. And in 2026, the rules around those subsidies changed dramatically. In fact, the enhanced subsidies that you're probably familiar with that were in place from 2021 all the way through just this past year, 25, have expired. The subsidy cliff has returned. What that means practically is that the ACA premium subsidies in 2026 are only available to individuals with modified adjusted gross income, or MAGI, which is below 400% of the federal poverty level. So for example, if you're single, that threshold is 62.6K. If you cross that 62.6K line by a single dollar, you lose the entire subsidy. Not a portion of it, all of it. The problem is people just don't see this coming until it's too late. And capital gains count towards this ACA MAGI, modified adjusted gross income. What this means for you, if you're a pre-Medicare retiree who decides to harvest $30,000 in gains from their brokerage account, a completely reasonable rebalancing move for many people, it can inadvertently push you over that subsidy cliff if you're not modeling the full income picture first. The average 60-year-old you see above that threshold faces unsubsidized premiums that can exceed $1,200 per month. That's over $14,000 per year in additional healthcare costs, which are triggered by what looked like a tax-free transaction. I can't stress this enough. If the 0% capital gains tax bracket is any part of your retirement plan and you're a pre-Medicare retiree, you absolutely must be modeling this out carefully, down to the dollar. And this is, truthfully, where working with a professional can be very well worth the cost. Shameless self-promotion moment, but if this is you or sounds like someone you know, I would highly encourage you to click the link in the description below to book your free consultation with us, and we can walk through the numbers together. Because you see, this hidden gotcha is often the one that surprises people the most, because the math on the capital gains side looks clean. It's only when you add in the healthcare cost impact and everything else that goes along with that we'll walk through in a minute or two that you see what the transaction actually costs in total. Ergo, the proper approach for a pre-Medicare retiree isn't to simply avoid harvesting gains. It's to identify the subsidy cliff threshold first, work backwards to determine how much income room remains, and calibrate the harvest precisely within that window. A $20,000 gain harvest that preserves a $12,000 annual healthcare subsidy is an entirely different financial outcome than a $30,000 harvest that destroys it. So, you're now carrying two constraints simultaneously: the Social Security provisions income threshold and the ACA subsidy cliff. And that's before we've even touched the third trap, which applies to retirees with larger portfolios and arrives without the warning that most people would expect. So, again, if your portfolio is 7 digits or more, you're definitely going to want to listen in to this next section, which we're going to discuss 3 more ways that the math can go completely haywire and mess up what looked like an otherwise completely clean transaction. So for retirees with substantial investment portfolios, there's a 3.8% federal surtax called the net investment income tax. Maybe you've heard of it. It's sometimes called NIIT for short. And that sits on top of whatever capital gains rate applies. This tax was created to help fund the Affordable Care Act back when it first came out. And it kicks in for single filers with MAGI above 200K and married filers above 250K. Now, critically, those thresholds are not inflation adjusted since the net investment income tax kicked into play. They've been frozen since that date in 2013. And as portfolios grow and required distributions rise, more retirees cross those thresholds than ever before. And sometimes in a single year where a large gain harvest pushes them over without warning. At that point, what was supposed to be a 0% transaction becomes a 3.8% transaction, and potentially higher once you factor in the other pieces that we were just talking about. Ordinary income tax on Social Security being a perfect example. Now, the second issue in this is more operational but equally important: cost basis complexity. And again, this is where a shameless self-promotion, working with a professional, can be very handy, because most retirees who've been accumulating holdings for decades have dozens of individual tax lots at different purchase prices, often with dividend reinvestment, adding new lots every quarter for years upon years. If you sell some shares without identifying which specific lots you're selling, you can generate far larger gains than you intended. And using the wrong accounting method, or just letting your custodian, Vanguard or Fidelity, default to one when you make the trade, it can turn a carefully planned harvest into an accidental tax event. And this is the kind of detail that belongs in a pre-trade review, not a post-trade surprise. Now, the third issue is one that sophisticated planners actually wrestle with constantly, and that is the Roth conversion crowding problem. Many retirees in the years between retirement and RMDs are trying to do 2 things at once: harvest capital gains at 0% and convert pre-tax dollars to Roth while income is low. Both strategies compete for the same taxable income budget. Aggressive Roth conversions can fill the 0% capital gains bracket entirely, leaving no room for gain harvesting. And aggressive gain harvesting can push income high enough to make Roth conversions land in a higher bracket than intended once you factor in all the other income sources. Doing both well in the same year requires modeling the full interaction. It is achievable, but it requires precision. Retirees who try to do both by feel rather than projection end up frequently doing neither one optimally. You don't want to do it by feel. You don't want to do it by the seat of your pants. You want to do it by, again, precision. Now, all 3 of these issues have solutions. What they don't have is forgiveness for the retiree who discovers them in April of the following year. So I'm going to show you 2 case studies here of what this looks like in practice. One pre-Medicare and one post, and what the difference between planned and unplanned actually costs if you're looking at using that 0% capital gains bracket in retirement to truly create what amounts to tax-free income. All right, so let's meet Catherine. Catherine is 62 and retired 18 months ago from a senior management role. She has $1.2 million in a taxable brokerage account built over 3 decades of disciplined investing, with an average cost basis of roughly 40 cents on the dollar, meaning significant embedded gains. She has a $600,000 traditional IRA, and she is not yet drawing from that IRA, and she has no pension. Now she's on the ACA marketplace coverage and currently receives an annual subsidy which is worth approximately $11,000 based on her projected income, which she has carefully planned out and tightly made sure that it's going to fit within her band so that she doesn't pay through the nose for that health care. Now, beyond supplementary draws from her checking account, the only notable income this year is $28,000 that she plans to draw from her IRA for living expenses. She's heard about the 0% capital gain strategy and wants to harvest $60,000 in gains to rebalance a concentrated equity position in technology that she had accumulated. The gains look free, but let's see what actually happens. First, her ACA exposure. Her Magi before the harvest is 28K, comfortably below that 62.6K subsidy cliff for a single filer. Adding 60,000 in capital gains brings her Magi to 88K, well above the cliff. She loses her $11,000 annual subsidy entirely. Her monthly premium jumps from roughly $300, quite affordable, to over $1,100, which will come as, I'm sure, quite the shock. The capital gains were tax-free, but the healthcare cost is real and immediate. The net financial impact of the harvest is actually negative. Whereas a more reasonable approach might look like Catherine's safe Magi window being the 34.5K between her current 28K of income and the 62.6K cliff. After accounting for her IRA withdrawal, she has room for roughly 34.6K of capital gains without losing a dollar of that subsidy. And she can do so without triggering any Social Security consequences since she hasn't yet claimed, right? Now, done annually over the 3 years before Medicare, that could amount to over 100K in gains harvested at zero federal tax. Her subsidy remaining intact and her portfolio meaningfully rebalanced. The difference between that plan and what she almost did is truly significant. This is why such careful planning can make the difference between making or breaking that plan. All right, so with us having discussed Catherine, let's talk about a married couple, Richard and Helen. Richard is 68 and Helen is 66. Now, both are on Medicare. They receive together $54,000 in Social Security, and Richard draws $24,000 annually from his traditional IRA. They hold a $1.8 million taxable brokerage account with significant embedded gains that they've been meaning to address for years. Their baseline AGI before any capital gains is $24,000, that IRA distribution we just talked about. Provisional income for Social Security purposes looks like this. It's that $24,000 plus 50% of their $54,000 benefit from Social Security, which equals $27,000, altogether meaning provisional income is $51,000. Now that's already above the $44,000 upper threshold for married filers, which means that 85% of their Social Security, $45.9 thousand, is already taxable at baseline. That's their starting position before they touch the brokerage. Now here are their deductions. They take the $32,200 standard deduction this year, $3,200 for both spouses over 65, and $12,000 in senior bonus deduction under the One Big Beautiful Bill Act, that OBBBA we mentioned earlier, which totals $47,400 in deductions. The taxable income before gains is approximately $22.5K. The 0% capital gains threshold for married joint filers is $98.9K, meaning they have roughly $76,000 of room before capital gains begins to be taxed. But here is where the NIIT constraint kicks in. Their modified adjusted gross income before harvesting is $24K. Their NIIT threshold as a married couple is $250K. A large gain harvest, say $200,000, keeps them well under the NIIT threshold, but it does push their total income into the 15% capital gains bracket after the 0% window closes at $98.9K. The gains above that line are taxed at 15%, not 0%. The optimal harvest here might look like $76K, that amount that fills that 0% window almost with bullet-like precision, if you will. Now, there's one more wrinkle. Richard is also considering a $50,000 Roth conversion this year. Adding that to the $76,000 harvest pushes their combined income to $150,000 or a little more, which crosses into that 15% capital gains bracket and renders part of that harvest taxable. The Roth conversion and the gain harvest compete directly for that same budget. So, a potential solution here could look like this. Choose. In other words, prioritize which is more important. With income already elevated by the full IRA distribution and Social Security, the Roth conversion is likely the higher priority because it permanently reduces future RMD exposure. And if they don't have a Roth IRA, it can also start that 5-year clock we talked about. The gain harvest can wait for a lower income year or be split across 2 years to keep both strategies within their optimal windows. The key lesson that I would like you to retain here as we're talking about all of these things is that this strategy, like your financial plan as a whole, is not unlike a great jigsaw puzzle where each piece needs to fit together with the others in order to reveal the big beautiful picture, if you will. And the time to plan is now, not after the tax returns are already filed and you're already facing a massive surprise bill from the IRS. So, a taxable brokerage account managed thoughtfully can deliver something genuinely remarkable, which is meaningful tax-free income in retirement, flexible access without mandatory distributions, even before age 59 and a half, and a stepped-up basis at death that passes to heirs without a capital gains bill. It's a tool that rewards planning in a way that very few accounts can match. So that 0% rate, yeah, you've heard about it, it's real. But the traps are equally real. The Social Security tax torpedo, the ACA subsidy cliff for pre-Medicare retirees, the NIIT threshold for larger portfolios, the cost basis complexity hiding inside decades of accumulated lots, the Roth conversion budget that competes for that same income space. None of these disqualify the strategy. Rather, they define the conditions under which it operates and the precision it requires. So, again, if this raised questions about your own portfolio, about what's sitting in your taxable brokerage, what your income picture looks like, and whether you're capturing this opportunity to its fullest extent or possibly walking away inadvertently, then that conversation is exactly what I do. And there's a link in the description to book a consultation with us completely free of cost. And this analysis is the kind of thing that needs to happen before you execute, not after. So again, I encourage you, go ahead and click the link. I'd love to have a conversation with you. In the meantime, I'll see you out there.